In this session, we'll cover a few more of the notes on capital budgeting. In fact, we probably should finish them in this session. And in this session, we'll start with page 32 of the notes, which is a forecasting discussion, which is something you have to do with your team project. You really will be forecasting out several years, trying to assess the benefits, the timing of the benefits, the size of the benefits. So we talked about forecasting with the cash handling project, and there many assumptions were given to me by the payroll department or by the cash management department or by the information technology department or by CFO. So you need to have a source for all your forecasts. You want your forecast to be on a cash flow basis. This is not accounting, this is cash flow. You can read the notes through there. I do have a discussion there on what do you do if management's interested in the impact on GAAP financials. And I do recommend in those cases you can do both on a cash flow basis and on an accounting basis, just so management knows the impact. But ultimately, everything is on a cash basis. So that gets us to the issue, what is a relevant cash flow? Relevant cash flow is anything that would change if you do this project versus if you didn't. It's really a brainstorming idea. I will help you as much as I can on your projects to help you brainstorm things you might forget, like insurance. If you're doing the case of buying a car versus using ride share, not buying a car, you'll save on gasoline, obviously, you'll save on maintenance, you'll save on auto insurance, save on parking. You just want to brainstorm what's everything that we could save if we do this project. On the solar system, the solar panels, we've had teams ask what is the impact on homeowners insurance of having those on the house. I've gotten different answers on that, but you still want to check on that. You want to talk about tax credits that you might get if you buy the solar panels. So you really want everything you can possibly think of. It's an incremental cash flow. We're talking about the delta, the change. The cash flow is if you do the project versus if you don't do the project, and it's everything counts. It includes, on the next page, you can see avoided costs. So if you were to buy something today, and because you have this new technology, you don't have to hire someone in 3 years. Let's say the volumes of your business are growing fast, and at some point you would have to hire new people. But because you're doing this project, you'll be able to handle the volumes more efficiently, and so you don't have to hire a new person in 3 years. That avoided cost in 3 years should be part of your benefit of your project. You can see some other examples in that section, but bottom line is just think through everything that could possibly happen with and without the project, and it's whatever the difference is what you want to include. What you do not want to include is financing costs. You want to make sure you do all your projects on a full cash purchase basis. So in the car versus using rideshare, you want to assume you buy the car up front with cash, not that you have an auto loan. You want to ignore the auto loan. The discount rate captures the fact that you might borrow money. Any investment earnings that you'd make on the project, remember I talked about internal rate of return and net present value have a reinvestment assumption. The discount rate already captures that. You don't need to handle what do I do with the cash if it comes in. You do not include sunk costs. The fact that you spent some money on this project in the past, that's already happened. You can't do anything about that. The question is, do you spend more money on this project to get it where you need it to be? And then, as we talked in last class, allocated costs, we don't want those. You don't want people's that say, oh, I spend 5% of my time on this department, and so 5% of my costs go to this department. But if that department went away, you would allocate that time somewhere else. Your costs would not go away. In practice, the next section talks about tax benefits. Those are extremely important, but we're ignoring them for this, for your team case, just to keep things simple. Taxes can make things very complex because the tax code is very, very lengthy, very complex. And I don't want to get into that. You may have an accounting class that will actually get into the tax code related to cost benefit analysis, and that's fine. My approach where I worked was to take my project, go to the tax department. I knew the head of the department very well. She had a wonderful department, very good research analyst. I would just take my project to them, and they would come back and tell me exactly what my tax cash flows were. And they made it very, very simple, and I didn't have to worry about figuring out, do I use the maker's table for depreciation? Is it double declining? All those kind of things that the tax law requires. I just left that to them. And they'll tell you what the correct tax rate to use. You want to use the marginal tax rate, which is the tax rate on the next dollar the firm earns, because you are making a marginal decision. We already talked about the issue of how far out in the future do you go, but essentially you want to go out and far in the future as the whatever you're investing in will last. If you're doing the solar panels, it might be 25 years. You're buying a car, it might be 7 years. For those doing the college, buying a house versus staying in a dorm, it's going to be however long the student would be going to college, 4, 5, or 6 years, because you're going to resell the house when that student finishes college. The digitization of the library, it's how long you think that benefit will last. It just depends how far out in the future does it make sense to go. So that's a subjective decision, but it should have some rationale to it. But you really want to figure out the economic life of the project. So there's a few other discussions down here. We've talked about most of them. At the very end, I give you an article of a cost-benefit analysis from it's an article that a man was buying a turbine, a $15,000 wind turbine for his backyard, and he was saving $20 a month in energy bills. He got a $3,000 tax credit, and he said, even if it was a 50-year payback, at least I've done something to reduce our dependency on fossil fuels. But if you actually do the math, the payback on this project is infinity. It never pays back, because the $20 a month, even if you grow that with inflation over time, is not near enough to ever pay back the $3,000 he invested. The $12,000 that he invested, $15,000 versus the tax credit, and that's because the cost, the time value of that $12,000 investment is more than what he's getting in benefits. So he never pays back the project. So that's the forecasting. We'll get in more detail on forecasting for a firm doing balance sheets, income statements, but for your project forecasting, the key is to get everything that is relevant to your project, anything that will happen because you do the project. So what I want to do now is I want to go into the cost benefit analysis in the Excel applications, Excel application 5. I will do the first problem, the Brittany Corporation, and then you have 2 others that you need to do. If you get the first one set up, the other 2 are very easy. One thing very, very important here, it says answer each of these questions below. There's 3 questions in a Word document. You don't need to do that. You can answer it in your Excel spreadsheet, and I'll show you how to do that. It's very, very simple. So I don't need a detailed answer on that. You'll see how I'm going to work it. So I'm going to go into Excel and copy this problem. So we'll take those 5 lines, and I'm going to copy them. And I go into Excel, and remember you can take several cells and use your shift and your arrow key, and if you do Alt H M C, it will merge all those cells together, and then you can just Control V and paste in the problem. So there's the problem. I can actually get rid of a couple of these rows because I merged too many together. I don't want to waste space. Oops, went too far. All right, so there's our project. So in row A11, I'm going to put this project in there, and in row in A11, just like we did with the project for the cash handling, I'm going to put time. And then in B11, I'm going to do cash flows. In your cash handling project, we had to have several columns to figure out the cash flows because we needed to do all the math. But here that's given to us. If you look at the actual problem, there's a cash flow at time 0, $580,000. Then year 1, there's a cash flow, year 2, and year 3. And so we'll do just like we did in the cash handling project. We'll do equal today, open parentheses, close parentheses, and then on the second year, on the first year, that's time 0, that's today. I'll keep showing you the formulas next to it. Then the next year, we want to do equal that previous date, and we want to go use a half-year convention, so we want to add 182 or 183 days. I'll do 182, and that takes us to September 20th. That's that half-year convention that we'll just assume the cash flows happen evenly throughout the year. And then the next year, you want to go a year and a half out into the future, so you will take the previous year and add 365. That gets you to where you need to be there. So 9/12/2021. And then you can just copy that one down, and that gives you 9/12/2022. So there's the formulas for that column. And remember, the logic is I'll put it below the column. The formula that's right below the column, it goes in the first row, then the next row, and if I don't copy it anymore, then that means the last one you had, you just copy that down for the remaining columns. All right, so now what we're going to do is bring the cash flows in. So you can see the cash flows. They're given in the problem. At time 0, there's an investment of $580,000. In the first year, you get $149,630. In the second year, you get $250,000. And in the last year, you get $280,000. I'm going to go highlight those. And like I said on the other problem, if they're dollars, I want to show them as dollars. So I'll hit the dollar sign. I don't want decimal places, so I'll take that back. So there's no formula here. You're just keying the numbers. And then down below, we will do the net present value, the internal rate of return, and the discounted payback. I'll extend that column so that they fit. And so here, remember, it's very, very simple. You just let Bill Gates essentially do the formula for you. So you do equal X NPV. And Bill Gates says use the rate. So I'm going to escape out of that. I'm going to go up above, and I'm going to actually type in my discount rate. So I have it, the reference. You can see in the problem, if you go to the top of the problem, our discount rate is 7.5%. You see it? Brittany's weighted cost of capital is 7.5%. So I'll do 7.5%. Here's my discount rate. And so now I can do my net present value equal X NPV. The first thing it wants is that rate. We don't have to lock it in because we only need it once. Comma, your values. So your values are all these numbers. Comma, and then your dates. And of course your dates are over there on the side. Close parentheses. And there's your net present value. Let's put it in dollars. We don't need decimals. So you obviously don't need to do what I just did in D. I'm just showing you the formulas. So what I did in D17 is to let you know what the formula is that I just did. For the internal rate of return, the same thing, equal X IRR, open parentheses. They want the values and the dates and it does not need the guess. So if you do the dates and hit the right button, I was hitting the wrong button, and hit enter, it will give you an internal rate of return. You can use the percent on that. I usually go at least 1 or 2 decimal places, but there's no rules on that. So I'll copy that formula over so you can see it. Now the discounted payback. This is where you need 3 columns, and this is the tough thing. It's probably the hardest thing on the final exam. The first thing we need is we want a cumulative net present value. I may not use the exact same titles I use in the problem we did in the cash handling product, because I don't remember exactly what I said. There's different ways you could describe it. So I'm going to lengthen out my columns. So the cumulative net present value, then we're going to do each year's net present value, or present value, and then we'll do percentage of year used. Something along those lines. Any title is fine as long as it somewhat describes what we're doing. On the cumulative net present value, we're going to do the equal XNPV again, just like we did before, except for we're only going to do it through this first year. So we go up to our rate. Here we do want to lock it in. So put a $sign before the 9. The next thing you want are the values. Here you only want to go through the first year, and here you want to lock in that row 12, and then very end you do the dates, and again you just want times 0 in the first year. Whoops, sorry, my computer does some funny things, so let me fix that. You just want times 0 in the first year. Whoops, it did it again. Sorry about that. So yeah, my mouse has got a few problems. There he goes. And you want to go back and again put the $sign before the 12 on A12. Put that in dollars. Sorry, that was a little bit messy. So that's your, at the end of the first year, net present value is still negative. It's negative 435,670. You can now copy this down. So you don't have to change anything, and you notice that the net present value at the end, the 22,363, is the net present value. We're just showing how it grows over time. So you just need this one formula. I'll put it down here at the bottom so you can see it. You just need that one formula. And then each year's net present value, you just take the net present value at the end of that year minus where you started. So for the first year, you do the net present value at the end of year 1, and you subtract the initial cost. So the first year's net present value of that cash flow was 144,330. So the present value of 149,630, discounted for half a year at 7.5%, that's 144,330. The next year, you take the net present value at the end of the second year minus the net present value at the end of the first year. And so the present value of $250,000 at 7.5%, discounted for 1.5 years, is 224. And then you can copy that down. Oops, let me undo that. So there's that formula. And that formula. You notice how this looks very, very, very much like what we did with the cash handling project. All right, so Let's do the percentage of the year used. Hopefully you have these formulas down. I'm going to actually move these lines down a couple just so I can bring these formulas down. So you can see the formulas that we're using. All right, and then the last thing is the percentage of year used. So this is what we saw. This is the most complicated thing of the application. So what we're going to say is, hey, when did this project go from a negative net present value to a positive? When was it exactly 0? So we needed all of year 1 and it's still negative. We needed all of year 2 and it's still negative. But sometime in year 3, pretty late into year 3, the project goes positive. So somewhere 2.5, well more than 2.5 years, this project is what this kind of payback is. So we're going to ask the question here in the formula. We're going to say equal if the current year is less than 0. If we're still negative in the current year, then we needed 100% of that year. Comma, well, comma means what if it's greater than 0? Well, if it's greater than 0, then we want to ask if the prior year was greater than 0. If the current year and the prior year are both greater than 0, we don't need any of this year. So we do comma 0. Otherwise, we do comma. We ask how much was the deficit. We do minus the deficit the previous year divided by this year's present value. And so we hit enter. We don't need to lock it in. I need one more. I don't always get this right the first time, but that was 100%. Let's see if I got it right. Doesn't look good. So there's some error in there. Let's see what it is. Oh, that does look right. All right, so we used 100% of the first year, 100% of the second year, and then you notice we used 90% of the third year. Why is that? Because we started with a deficit of 211,349, and we only had 233,711 in the third year. So we used most of that year, 90% of that year, before we went from a negative right to 0. All right, so this is a formula. You only need it once, and you can just copy it down. So once you get the first year right, if you did it correctly, the others will follow well. Now on the final, this is probably the toughest thing to do on the final, so you may need some practice on this. You can do it manually. You can say, oh, I need 100%, I need 100%, and then minus 211,349 divided by 233,711. But it's better to set it up as a logic function using the if functions because it's a really powerful tool in Excel. All right, so then your discounted payback is nothing more than the sum of those 3 numbers. It shows it at 290%, but we're going to do it in years at 2.9%. And so, yeah, all you got to do there is just the sum of those. So there's your formulas. Let me move them down here below so you can see them. So there's your 3 formulas for that section. And so the last thing you've got to do is simply ask, is this project to accept or reject? If you look back at the question in the Excel application, it asks, calculate the net present value. We've done that. Based on your calculations, do you recommend the project and why? So we got to get that. Do you recommend it? Do you accept it or reject it, and why? Same thing on discounted payback, and same thing on internal rate of return. All right, so let's build that into Excel using the if function. So if the net present value is greater than 0, you want to put the entire answer in. This is very important on the exam as well. We type except, comma, because the NPV is greater than 0, close your quotes, comma, reject, comma, because NPV is less than 0. Close your quotes. So that tells you whether you accept or reject. So you accept, which is do you accept or reject is one of the questions, and then the why, it also answers the why. The next one, internal rate of return. So here we want to see, is our internal rate of return greater than the cost of capital? Our cost of capital is 7.5%. So we're going to say equal if internal rate of return is greater than 7.5%. You don't have to lock it in because we're only doing this once, comma, except, comma, because IRR is greater than cost of capital, close quotes, comma, reject, comma, because IRR is less than cost of capital, close your quotes, hit enter. So now you've got that you accept it and the reason why. And then the final one, we have to look back at the notes. But you notice in the notes that it says Brittany's cutoff period is 3 years. That's just given. Remember, for your projects, I don't need you to give me a cutoff period. I just need you to calculate the discounted payback. So their payback is 3 years. I don't know why that switched back to percent. So we're going to say if equal if the payback, equal if the payback is less than 3 years, comma, except because payback is less than cutoff, close quotes, comma, reject, comma, because payback is more than cutoff, close quotes, hit enter. So there's your formulas for that section. If you're having any problem, then you can just pause the video and you've got all of your formulas for each column. You can see the entire thing and you can see the answers. Once you have this set up, you should just be able to copy this to another sheet. You don't need to have, again, these formulas I'm showing, you don't need those in your project. You can leave that out. So notice that I added a few rows. I mean, I moved this down so your rows may be a little bit different. It'd be best if you put everything exactly where I put it, just to help you get everything organized. But that's what you need to turn in, and so I don't need a Word document. As long as you have these 3 things typed, that tells you whether you accept or reject and why. I do need to see the why. Some students forget to put the why in there, but if you do that, you've got everything I need for the Excel application. You'll get full credit. All right, that's it for that, and I'll stop it here. And we'll look forward to the next video.